Gold just hit $4,399, while Bitcoin slipped below $65,000. You hold one of these, your portfolio is screaming right now. Heading into the new week, Sunday, August 9, 2026. Like and subscribe for daily market updates. Today's agenda, Week in Review, Market Snapshot, Gold Surge Explained. Here is where things stand right now for every asset class you care about today. This week in markets was a roller coaster that felt like it lasted forever. We started with Bitcoin testing $65,000 support, but getting pushed back down to 6472730, which is negative 0.28% for the session. Gold did something wild though. It climbed all the way up to $4,399.70, a massive plus 2.33% gain in one go. That divergence matters, because usually when stocks wobble on inflation fears like we saw with that record, the S&P 500 closed Friday at 7,758 points. Gold acts as the safe place to store wealth, while risk assets bleed. But here is what surprised me. Oil prices surged past $80 per barrel, even though I predicted crude would climb back toward $80 if talks moved. Instead of moving lower due to a deal near Hormuz collapsing, Brent climbed into the low 80s at 78.18 for crude oil, and higher overall. Wait, that number sounds wrong. No, it's actually up plus 1% as Middle East conflict continues. The S&P 500 posted its strongest week since April because a weak jobs report surprised everyone to the downside, which lowered odds of Fed hikes in September significantly. But you have to ask yourself, does this mean rates are finally dropping, or is inflation hiding somewhere else? Now let's look at today's picture. Up next, Gold Surge Explained. Let's get straight to the numbers, because they tell a story of confusion and opportunity. Bitcoin sits at $6472730, down slightly from its recent highs near $65,000, where it was caught in that tug-of-war between Fed easing hopes and Iran war fears. Ethereum is flat at $1,912.61. Altcoins lost their luster, while Bitcoin held up. Solana dropped to $75.88, which feels like a correction after some gains earlier in the week. XRP dipped too, but remains above its key support levels. Look at stocks. The S&P 500 closed Friday at 7,758 points, plus 0.62% for the session. Nasdaq rose to 26,691 points, with a strong 1.30% gain. Dow Jones also climbed as SpaceX shares soared. Gold is breaking records now. It hit $4,399.70, up plus 2.33% in this session alone. That's huge for anyone holding physical metal or ETFs linked to gold prices today. Oil jumped too. Brent crude reached $78.18 with a gain of 1.15%. The dollar index is sitting at 99.60, basically flat plus 0.07%. Why does this matter? Because if the greenback stays weak while oil rises, your energy bills could spike without you noticing until next month's utility statement arrives. That brings us to oil price surge. Gold surged past $4,399 as bond yields stabilized, and the Federal Reserve signaled an end to aggressive rate hikes. Lower borrowing costs reduce holding expenses for non-yielding assets like bullion or ETFs such as GLD. However, persistent inflation fears, driven by surging oil prices, challenge this rally significantly. Investors must now view gold not merely as a luxury store of value, but as an essential hedge against eroding purchasing power, particularly for small businesses drowning in mounting debt service obligations, before critical monthly deadlines arrive. Historically, sharp moves often precede corrections, unless accompanied by broader global political instability. Indeed, the market remains fragile regarding tensions involving Iran. If yields remain suppressed below 4.7%, a scenario that defied earlier predictions, after recently spiking another full percentage point, gold could easily surrender half of its gains before Friday's close. What happens if diplomatic talks fail or military escalation occurs in the Middle East? A spike in unpredictable price swings triggers flight to safety flows regardless of yield data then. For investors, holding physical metal offers tangible protection against currency debasement and supply chain shocks. Yet, timing entries requires vigilance on both central bank policy shifts and global political flashpoints. The current setup suggests a volatile trading range, where portfolio diversification into hard assets remains prudent until external threats subside or yield curves normalize further. You must balance the allure of recent price appreciation with the ever-present risk of rapid reversals driven by unexpected global events, which leads to Bitcoin's struggles. Oil prices surged past $80 per barrel today, defying my earlier prediction that crude would merely climb back toward that threshold pending diplomatic talks. Instead, Brent climbed into the low 80s at 78.18 for crude oil, and higher overall as Middle East conflict continues to threaten Hormuz shipping disruption. Blockade of that narrow strait could shock inflation, because it carries a fifth of world's oil supply. Any disruption sends prices soaring fast enough to hurt everyone from grocery stores to airlines, echoing the 1973 embargo, which triggered stagflation by severing global trade arteries. That matters significantly, because if fuel gets more expensive, your monthly budget shrinks unless you adjust spending habits immediately. This unpredictable price swings forces investors to reconsider exposure in energy sectors, while hedging against supply shocks that could persist for months rather than weeks. The mechanism here is straightforward. Global political friction reduces available inventory, raising interest rates the market and driving costs up through every tier of consumption. Consequently, consumers facing higher heating bills or gas prices must anticipate reduced discretionary income unless they rate change toward more efficient transportation options sooner rather than later. Let's wrap up what you should watch for Monday morning when markets reopen after this weekend. Bitcoin stands at a critical juncture near $65,000, caught between diverging big-picture economic forces that could dictate its next major move. On one side, recently weak employment figures have sparked speculation that the Federal Reserve will rate change toward rate cuts sooner than expected, a scenario historically positive on prices for high-beta risk assets like cryptocurrency. This expectation of cheaper capital flows typically fuels rallies in tech and digital stores of value. However, this optimism faces challenges from global political instability. Escalating tensions involving Iran are driving oil prices higher, which simultaneously dampens global growth expectations and squeezes profit margins worldwide. The ripple effects extend beyond multinational corporations to small businesses facing imminent debt service payments as cash flow tightens under rising energy costs. Consequently, Bitcoin slipped 0.28% today to settle at $647,2730, testing the psychological support level near 65,000, but lacking the conviction needed to breach higher resistance zones immediately adjacent. Meanwhile, Ethereum held steady at $1,912.61, while Solana retreated below $76 after an earlier intraday surge that likely attracted short covering pressure. The market's hesitation is not merely technical. It reflects a broader investor strategy of waiting for Wednesday's inflation report to release inflation data, which will serve as the definitive trigger deciding whether risk assets rally on in favor of lower rates policy signals or decline sharply if prices prove sticky and force in favor of higher rates commentary from policymakers. Let's finalize our thoughts on how to position yourself for the week ahead. Here is where things stand right now, heading into the new week. You need 3 key numbers on your radar: Bitcoin at $647,2730, gold above $4,399, and oil near $78.18. These assets are currently tethered to a delicate balance between fiscal policy and global supply chains. If inflation data comes in hotter than expected Wednesday, risk assets like stocks and crypto could tumble sharply as rate hike fears revive. This isn't merely about higher borrowing costs. It triggers a second-order effect, where capital flees growth-oriented sectors for the safety of bonds, potentially repeating the unpredictable price swings seen during 2018 trade war escalation, when unexpected data caused immediate market corrections. Conversely, if inflation data is cooler though, the Fed might cut rates sooner than anticipated, which would boost everything from tech stocks to digital currencies alike. Lower yields typically strengthen Bitcoin by making its high-growth profile more attractive compared to stagnant bond returns, while gold often sees a dual benefit as both an inflation hedge and a yield-free alternative becomes cheaper to hold. Also watch global political developments around Hormuz Strait. Any news of a blockade there sends oil prices soaring instantly, while dragging down global growth prospects significantly for everyone involved in international trade today. A disruption here would force central banks into defensive postures, compressing profit margins across energy-intensive industries and forcing investors to reassess long-term supply chain resilience strategies immediately. Finally, let's turn to final takeaway. To sum up this chaotic week, gold breaks records, while Bitcoin struggles near $65,000 support. Oil prices rise due to global political tensions around Hormuz Strait, which could escalate further any day now. Stocks rallied on a weak jobs report, but that doesn't mean inflation has disappeared completely. It just means markets already expected by the market some easing soon without confirming actual rate cuts, yet officially by the Fed chair or policymakers speaking publicly about their next moves today. Is this enough? This dynamic mirrors 1980 stagflation fears, where data softened before policy shifted, creating volatile trading windows for stocks and bonds alike. You must remain vigilant as global political events continue to unfold rapidly, impacting energy supplies and consumer prices globally. Investors should prioritize hedging strategies against supply shocks, while monitoring central bank communications closely. The divergence between headline jobless claims and underlying wage growth suggests a fragile labor market that could trigger unexpected monetary raising interest rates if inflation reaccelerates unexpectedly in coming months ahead of the Fed meeting later this year, when officials will likely address these lingering uncertainties directly during their press conferences. Scheduled for Wednesday afternoon, following the release of preliminary manufacturing data showing contraction across key industrial sectors. This week's markets proved volatile, ending with gold hitting a record high of $4,399, while Bitcoin slipped below its key support level near $65,000. Oil prices surged past $80 per barrel as geopolitical tensions around the Hormuz Strait intensified, threatening global supply chains from airlines to grocery stores. Meanwhile, many small businesses face mounting pressure, with monthly debt service payments approaching quickly amid these escalating economic uncertainties and shifting commodity trends worldwide. Thanks for watching Market Pulse Daily.